Hello everybody. As you can see from the massive slide, my name is Nick Edwards. I'm a partner in our business restructuring team, and I'm going to talk to you for the next 20 to 25 minutes about business refinance. For those who have met me before, you'll realise that up until quite recently the team that I was in was called Business Recovery and Insolvency. And I am actually a licensed insolvency practitioner, but you'll be very pleased to know I'm not going to talk to you about insolvency, and our business refinance service is nothing really to do with insolvency. It's much more about helping businesses using some of the skills that we've gained over the years with our in the other area that we deal with, helping businesses put together business plans, helping business put together forecasts, understand what sort of information they need to provide to their funders in order to get the right sort of response. But that could equally, particularly in the current market, apply to businesses that are growing, businesses that want to make an acquisition, as well as businesses that have struggled over the last few years and therefore need more funding in order to fill a hole. So you'll be very pleased to know there's not too many not too many bullet points. It's a fairly simple presentation. We're giving you an idea of what we do, give you some examples, and just try and put our service into context. I thought I'd start by putting up a picture of a bank manager. I was talking to a couple of people over coffee, and I promised not to do any bank bashing, but this is probably the closest to bashing that I get. Most modern bank managers obviously don't look like that, but I think the expression on his face is probably about right. I'm not sure so many bank managers are that enthusiastic about lending at the moment. I mean, there are a number of reasons for that. The environment within which they operate is much more difficult now than it probably was if you go back to the heady days of 2008. You've got Basel II, you've got Basel III, you've got weak security, you've got a lot of banks that have been trying to shrink down their balance sheet, and all of that has obviously had an effect on the availability of credit. So what does that actually mean in practice? I think what that means in practice is that the quality of proposal that you need to put to the average funder has to be that much better than it probably did before. The amount of information, the quality of the information, I think pre-2008, I think the bank did a lot of the work for you. Now you clearly have to do a lot more yourself. I think there's been a bit of a change in the way that they look at things. I think it's much more difficult to extend borrowing with your existing bank. I think the old assumption was, well, if we don't lend them the money, somebody else is going to lend them the money, and therefore we're going to lose this customer. I think things have changed now to, well, nobody else is going to give them the money, so we need to think very carefully about extending any facilities. And obviously for banks, I think increasingly banks are looking at sectors, and there's certain sectors obviously where it's very difficult to get funding, anything relating to construction. And in a number of cases, banks are looking for people to go elsewhere. We're not looking at businesses which are necessarily basket cases, but we're looking at businesses where they don't necessarily fit with the criteria that the banks are now applying. So there's the problem. Here's the solution. It's another picture of a bank manager, but the good thing about this bank manager is he actually works for us. He's somebody called Mark Huddleston. He's spent the last, or before joining us in January, he spent the last 20 to 25 years actually doing the bank manager's role, both at HSBC, Yorkshire and NatWest. His last job for NatWest was quite an interesting one. He was dealing with something which was euphemistically called non-core property, which is basically all the property which was sitting on the books at NatWest that they weren't particularly comfortable with, and part of his role was to move that on somewhere else. Of course, that's all well and good if you're the only bank doing that, but I think one of the things that we've seen over the last year or so is that so many banks have been moving out of property all at the same time that it's had a big impact. One of the reasons why we've become increasingly involved in business refinance was that with our insolvency house, when we're selling property, we could get offers for property, but could the buyers that we got lined up get finance? In a number of cases they couldn't, and we ended up actually, in order to sell the property, having to help them get the finance for the property as well. And that's why one of the reasons why we ended up doing this. Mark's a very interesting guy. Big thing about him is he's actually been there and done that. He knows how to write a credit report. He knows the sort of things that are going to maximise your chance of having a positive response, which I think gives us a bit of an edge. You know, I always thought I knew how the banks work because I spent a lot of time dealing with them in one way, shape or form. And sometimes, in the nicest possible way, banks sometimes do things that don't seem entirely logical from the outside. But of course, if you've not been within that organisation, you don't understand how it works, you don't understand the pressures that are on individual people within the bank. You don't really understand sometimes why you get this particular response. But Mark's been there and done that, and he's been very useful for me just trying to understand how people are going to respond. So he's a very key part of our business refinance service. But what do I actually mean by business refinance? I think all of the cases that we deal with under this particular heading are all a bit different, but there's probably four key elements to what we do. The first one, it seems a pretty obvious question on one level, is to sit down with people and establish what their funding need actually is. And I suspect that 99.9% of the people here, if you ever go to the bank and borrow money, you have a pretty fair idea of how much you want and why you need it. I seem to get involved with some people who, when you actually ask them that, sometimes the numbers seem a bit more soft than you would expect them to be. So actually helping them understand what they need, why they need it for, and that's linked to probably the second element. We do look very closely at the business as a whole, and sometimes when you look at these businesses, the management think they need funding, but they could fund some or all of this perceived requirement by just changing the way in which they operate. I mean, again, I suspect this is going to be pretty obvious for most people in the room, but you've got things like stock reduction, taking more credit from your suppliers, being much tougher with your debtors. But there's also, I think sometimes just by standing back and looking at a business critically, you can see things that perhaps directors sometimes can't because they're just too close to dealing with the day-to-day running. I've got one at the moment where it's not a bad little business, it's under a bit of pressure, but we looked at it and what it does is it exports machines across Europe. And one of the things it doesn't do is it doesn't charge carriage. And you're thinking to yourself, well, all your competitors charge carriage, and it's sort of £200 to £300 per machine. Why don't you? And it's really that, for whatever reason, she's never, she made a decision a while ago and she's never questioned that decision again. And just by charging carriage, she's going to make a bit of a difference to her business. She's going to drive much more cash into that business. The other thing just on that particular case was that we looked at her competition, and it turned out that what she was charging for after-sales servicing was probably a third of what her competition was charging. And again, that's another income stream that she hasn't made the most of, which is going to make a lot of difference to her business. She's still got a funding requirement, but if the underlying strength of the business is that much greater, it becomes a rather easier funding proposition. Third element, business plans and forecasts. As I said before, it's a lot more important when you go into a bank for funding to make sure that what you give them and what you give them first time round is actually everything they need, everything they want, and maximises your chances of getting the funding that you require. Part of that is making sure that you're backing it up with the right plans and forecasts, and that's something within our team that we have a great deal of experience of. And again, using Mark, he can make sure that it's put in terms that are really going to tick all the boxes with the bank. But clearly, you're covering off some of the questions that any sensible banker will have, which is, are you borrowing enough? Are you going to run out halfway through the process? How are you going to pay it back? And again, it seems very simple questions, but making sure that you've given a clear answer to those really improves your chances. And then the last point is fitting the right funding to the right business need. And again, you think that seems quite straightforward, but we've been involved in a number of cases where they've used exactly the wrong sort of finance. And this is a picture of the Hubble Space Telescope. And we were involved with a company last year where they actually provide some of the components for that. It's a very nice, in some ways it's a very nice business, but unfortunately the sort of business it was, it did a large amount of development work. The problem was it was funding the development work effectively with sort of overdraft, quasi-overdraft funding, which of course is very expensive. And there's the bank sitting there thinking, well, this business is showing profits year after year, but the amount that they're borrowing off us is getting bigger and bigger, and we don't quite understand what's going on. And really, we had to go into this business in some detail, work out where the money was going, and unfortunately, so much of the money was going into development costs, it became blindingly obvious that really this business needed to be funded by equity, not by typical bank funding. And in fact, we got quite a long way down the route of finding them some investors. But in the end, the directors had the personal wealth to put in. I think they probably needed about £500,000. But through our involvement, at the very least, we got them onto a far firmer financial footing where they had some sensible plans for the future and they had the right sort of funding in place. We've got 3 more examples here of some of the stuff that we've done over recent months. Mark, since joining us in January, has been pretty active in a number of cases. The first picture there is of a construction business that I was involved in, I'm still involved in. Very nice business, potentially has a huge opportunity. It's in a declining sector, but its major competitor was moving out of the market. It was a subsidiary of an international business. They decided they didn't want to do it anymore. This was potentially going to add £1.5 to £2 million on their turnover. First thing we did to them was said, well, yeah, that's all great. You're going to make a lot more money in theory over the next year, 18 months. But of course, in the short term, if you're adding that level of turnover, it's going to suck cash out of your business because you're going to have more tied up in debtors, more tied up in stock. And we worked out that they were probably short by about 100 to 150,000. The other problem that they had in a sector where their current bankers weren't desperately comfortable about lending, they were very over-secured. They had security over the, it was an invoice discounting facility. They had security over the debtor book, that then had security over property. They then had a fixed and floating charge over the assets of the company, and then they had a personal guarantee backed up by personal property as well. So again, it was belt and braces, and then another belt on top, and then another belt on top of that, which made it very difficult for them to borrow any more. And in that particular case, we found them, or we got them, we put them in touch with another couple of potential funders, and they were able to get a bigger facility with less security, which actually meant that they were able potentially to use this additional security that was released to borrow more money if they needed to fund the expansion. The second, that door is the door of a hotel. This was a case that actually came to us as a tax problem. This person was potentially sitting on a chargeable gain in excess of £1 million, and was thinking, well, how do I mitigate this from a tax point of view? But when we actually started to talk to him, it became clear that that was fine, but he had a cash flow issue, which meant that he was trying to sell the hotel, but he needed to make sure that the hotel wasn't, he had time to sell it over an extended period rather than getting sucked into some sort of distressed or semi-distressed sale, where that £1 million would evaporate. So we helped him put some forecasts together, helped him negotiate with the bank, helped him make sure he got the support that he needed to fund trading whilst he looked for a purchaser. He's now got a purchaser, and once that goes through, he's going to make so much money that he is going to need some tax advice from us. Third one's a railway business. This was a very nice business. It historically had always made loads of money, and the director's relationship with the bank was pretty well non-existent on the basis that, well, they lent him the money. He was making so much money, he didn't particularly need it, and they weren't chasing him. Then he ran into a bit of a bump. He had a big bad debt, and at that point, cash was that much tighter. The big problem was that his management information that he was providing was pretty awful, in the sense that he would send all this stuff to the bank every month, but no 2 months would ever reconcile one against another. Lots of little pencil marks on it saying, you've got to take that number, and then you've got to add that number to that number. He didn't actually have much of a clue where he was, and the bank certainly didn't have a clue where he was. Big part of that was not to find him new finance, was just to actually help him manage his relationship with his existing funders, who, if they understood his business a bit better, were very likely to be supportive. Again, I think business refinance is probably more to do with not businesses that are under huge pressure, not businesses that are failing, but it's more to help businesses that are a bit square pegs in round holes, may not have the right sort of finance, may not have the right relationship with their bank, or may not be putting their funding application in such a form that it makes it easier for the bank to say yes. And in that particular case, our main, the main things that we added to that particular case was, one, we actually helped him produce a set of forecasts that he understood and the banks understood. And the second thing we did is we put in some key performance indicators for him that he could provide every month, so everybody knew where they were. So there's some practical examples. And the other thing I was just going to touch on was some of the other forms of funding. I've talked a lot about, well, the banks do this and the banks do that. I think one of the issues that a lot of people are going to have to face is that increasingly the space that during the good old days of pre-2008 was occupied by the bank. If you're looking at funding things that aren't entirely straightforward, you're going to have to look other places as well. And again, we're getting increasingly involved with some of these things. The first two are fairly similar in principle, peer-to-peer lending and crowdfunding. They're based on the principle that if you borrow, say, 100,000 from one person, and it's a fairly risky situation, that person's perception of risk is going to be great, and the level of return, if he lends you the money at all, is going to be huge. But if you have the same funding needs and you borrow £1,000 each from 100 people, their perception of risk that they're taking in relation to that and the level of return that they're likely to seek is much less. And great thing about the internet is that it allows you to find all of these like-minded individuals that want to invest, particularly with low interest rates. So, difference between peer-to-peer and crowdfunding. Crowdfunding tends to be, well, it has a really big ethical slant to it, sort of charitable. There's a charitable element to it, and in this country at least, it's not really that big. It's much more to do with an equity investment. There's somebody called Crowdcube in the UK, but they've only really lent about 5 million quid. Peer-to-peer lending is lending to businesses that wouldn't necessarily fulfill normal banking criteria. There are a couple of people that lend serious sums of money. And we're talking about sums here in excess of 100,000. The two key players are somebody called Funding Circle, who, as I've quite recently heard, probably put about 100 million of funds out into the market. And then the other people who are fairly local are somebody called Thin Cats, and they probably lent about 21 million, I think, at the moment. It's a straightforward loan. You need to be introduced to them, so we work with Funding Circle. We would help people put a proposal which is then put on their website, and then people will, if they're interested, will pledge some of the money that they need. Interest rates, you're probably looking at, well, they're more than the banks charge. For something that's perceived to be fairly risky, you're probably looking at an interest rate in excess of 12%. Even for something that's perceived to be very low risk, you're looking at an interest rate of about 6%. So, but I think, given that there will be less funding available within the straightforward banking market, I think these people are going to have very much have a place. Property lending, it's still, if you have a very straightforward property generating a very attractive income, a very stable income, and of course it's still pretty easy to borrow money. There's a lot of property out there that doesn't fulfill that criteria. Like I said, this is how we got involved, partly in business refinance. One of the advantages that Mark has is he has a lot of links with people who are in that market, not in the main clearers, and again for a price, are prepared to fund properties that wouldn't necessarily be something that the main banks would be ordering themselves to fund. He also knows about certain people, and there are specialist lenders out there in particular that will help with letters of credit and even loans secured against future credit card income. That last one's very expensive, but going back to that case I'm working on at the moment, which is this machines business, one of their problems, of course, is that they need to import these machines from China. They need a letter of credit facility. The bank wants to be supportive, but it only wants to be supportive to a particular level. For her to grow her business, she needs to potentially make use of a separate letter of credit facility. Last one, venture funding. We've always been very active in the sort of the turnaround, sort of distressed investor area. We have some links with some of the major players, people like Better Capital, Arm Capital, which has proved useful in the past. Problem you tend to have with them is, yes, you can get the money, but the level of return that they're looking for in these sort of circumstances, because their level of perceived risk is so high, can be very high. This is something that isn't just linked to turnaround. Our corporate finance team, who we also work very closely with, we also have good links with rather more straightforward, more mainstream venture funders as well. But again, it all boils down to the same thing, which is really what's the strength of the underlying proposal? How do you prepare the proposal? How do you gather the information, the proposal, present the information that you've got in such a way that maximises your chances of success? So, next steps. If you're interested in anything that I've just been talking about more than, you can look at our website. We've got some more detailed information on some of these areas and a few guides. You can also talk to either Mark or myself. I'm more than happy to pick up the phone, talk through any issues that you might have. Key thing to note is that if you think there's an opportunity, if you think there's a situation where we can add value, we always go out to a free initial consultation, because until you've met somebody, you don't know whether you could help them or not. So more than happy to do that as well. In terms of where fees go after that, we tend to be fairly flexible. It's either a success fee, it can be on time cost depending on the nature of what we're doing, or alternatively, sometimes where we're introducing new funders, we can actually get commission for that, which means that, of course, the work that we do ultimately comes out of the profit margin of the people that we introduce, as opposed to necessarily the company that we're acting. So that's it. I'll be around for a while if anybody's got some queries. But